All right, so stocks started the week on a pretty decent foot, much better than how it ended last week. Of course, we kind of saw this type of day coming. We described it on Friday's Market Outlook video and pretty much played out as we expected it would. Similar to those other instances I told you about. But there's a key distinction about today's move that's different than what we saw those two other times. So we're going to break that down and talk about how that leads us into what we expect the rest of this week, especially with a big basket of earnings from big tech coming out this week. That's going to be major in terms of how bullish or bearish we are going forward. Not so much, the market's priced in some bearish earnings, so it's whether or not the earnings right now are good or bad doesn't matter. What matters is the rest of this year with rates rising as fast as they are, as much as they are. What are these outlooks going to look like for the rest of the year? That's what people are going to be paying close attention to. So we're going to break down some significant moves in the dollar today and talk about how significant that is. And then our trade idea is going to be a rare bullish one that we haven't done for a while. So let's go ahead and get started. Today is Monday, April the 25th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 first with the Market Forecast Indicator. And you can see, it played out very similar to how we expected. I mean, it wasn't a surprise because we've seen this play out before, twice, in recent memory. So we got the exact same pattern again, just to a smaller extent, not as extreme. We weren't as extremely down as some of these other periods, especially below the 30-day moving average. But it was still pretty bearish nonetheless here. And then, we went down. We touched that 23% retracement level on an intraday basis and then rallied, right? And then we rallied, however many points, 4,200 up to 4,296. So 96 points on 4,200. I mean, that's 2%, well more than 2% a gain over the course of the day. That's very typical. That's what we saw there. It's what we saw there as well. And that's what happens when you're so extremely oversold. But you notice that move didn't get your short-term sentiment lines up very far. Your bearish line still in oversold territory. You're still 3.5% below the 30-day moving average. The intermediate line still falling. So that today's rally didn't change anything from that perspective. If you look at the NASDAQ, you see here that we did get back above that 78% retracement level. That was the important break. We talked about the probabilities that we would continue to rally up to the 62% line. Hit that as a high point before we rolled over. I think that's still in play. The Russell 2000, same thing. We did dip below that 100% line on an intraday basis. We didn't get back, we didn't get below the 38% retracement over here. But we did dip below that. We came back up. We're not back above the 78% line on the Russell. So, again, this rally is not, it's not a snapback rally. It's not I guess we're not going to be bearish now kind of a rally. It was that was a very sharp sell-off that continued, into today. In fact, if you go look at, the comparison chart here, and we'll look at this in a second here a little bit later on a different time frame. But when you look at this chart and you look at, as we finished the day on Friday, down about 4%. Well, at the low, by the time we got down to the lows today, the S&P was down 5.75% over the course of 2.5 days, roughly. So that's a sharp selling. I mean, that's very, very sharp selling, and not surprised that you would rally and still be down for the IWM 4%. For the Qs and SPY is still down 3.5%. So you're still down pretty sharply here, despite the little bit of rally that we're seeing here. Of course, from a weekly perspective, you can see we got the bearish candle, very significant bearish candle. As of right now, we are closing below last week's low point. We are also getting a cross of the 10-week below the 40-week. So we're getting that bearish cross there. The NASDAQ, remember, already had the bearish cross so many weeks ago, and it's got a bearish candle, no upper shadow, falling PPO, red arrow, but not quite below, not quite a bearish close. The The Russell 2000, same thing. It's kind of flirting with a bearish close there, closing below that low point. No upper shadow, so really good bearish candle. It's a the differential's negative, the PPO still falling. We've had that bearish crossover quite a while on this one. So, we're maintaining a bearish long-term trend right now. We're just moving in the direction of that long-term trend, which for some odd reason still surprises some people. You still got light pink shading across the board, 3 arrows all the way across. So the only one that actually did not get 3 red arrows today, again, is the diamonds, because its stochastics turned back up. Its stochastics is not oversold like all the others. All the others, stochastics is way down. So a move up on the stochastics, it still keeps it red arrow. But because the stochastics is actually around the midpoint of the chart on the diamonds, it actually turned green again with this turn up. So, but everything else still pink shading all across. Again, that's bearish when you get extended period of time of pink shading there. When you look at the 2-line version of these charts, you can see again how important that low point is. And how more than likely we're going to come back down a little bit slower next time, but we'll come back down and retrace a lot of this range, and has a very high probability, in my opinion, very high probability of breaking that line eventually. Eventually, right? It doesn't have to be this week. I'm not a perma bear. I'm not a doom and gloomer, right? It's not going to be the end of the world. In fact, it actually would be very healthy. It would be a very good thing for us to get down there. Not because you want to short everything, but just because if a body can't exhale, then it's not going to be very healthy. So if you're going to inhale, you have to exhale. Markets are the same way, right? It's kind of like a living organism. It's got to inhale and exhale, and the Fed has really kind of kept it from being able to get a good exhale, good cleansing exhale, because we get so worked up about any little exhale. That we can't just breathe out, especially after a big inhale that we've had here. And so that's just the nature of the beast. And so we're going to rally up a little bit, probably a little bit more. But you notice we're nowhere near the 8-day exponential moving average or the 17. So we're nowhere near breaking the trend back to the upside, right? You have to get above the 17-day moving average for that to happen. And, again, you can kind of see it only took 2 days last time. And so here's that 24th. We got pretty darn close. We just stayed sideways, and they caught up to it, and it took a few days to get above the 17. There's February 24th. Again, we caught back up over a few days to the 17 there before moving that leg lower. So, you can see something like this happening again, where we catch back up towards the 17-day before we make, that move back down, most likely down towards lower lows by the time all is said and done. Same thing here. Again, well below that 17-day moving average. And you expect that you'll get up to it. Now we're below the point of control. We're below the value area. There's no volume below us on the 1-year chart. I mean, it's very bearish setup from that perspective. But that doesn't mean that we won't go up in the next day or two and continue what we saw here intraday on the markets. Directional movement index. So you can see we're still above 30. We're still below 20. So that hasn't changed, and another up day or two won't change it either. Same thing with the Qs. We're still above 30 barely. And then IWM, whoops, I can't see my keyboard with my microphone here in the way. But it's the same thing again. Well above 30, well below 20. I mean, you are easy breakout modes here. We're not like 1 or 2 days will not change this bearish breakout picture. Still well below minus 200 on the CCI. Below 40 on the RSI, the NASDAQ, same thing. Below 150 though on the CCI, and then you can see the Russell, same thing. It did bounce a little bit back above 40 there. If you look at the Bollinger Bands, we're still in the lower quartile, even with the rally, easily in the lower quartile there. The Qs are also barely in the lower quartile, and then IWM also in the lowest quartile. So everything is looking pretty bearish from that perspective. SPY has now very close to a intermediate trend strength, so getting above 65 and below -2 would be intermediate trend strength. So we're almost there. The Qs are closer, right? Almost below -2, almost above 65, well below the cloud on that. And IWM, again, well below the cloud. -2 and 65 are the key numbers. So I mean, this is the biggest. This is the trendiest IWM has looked since we've gone this sideways, right? So it is more bearish than we've seen. It's the lowest. Let's see. The biggest number we had up on the top was 1.13. So this is -1.58. So it is the biggest number we've seen on the trend quality as well. So this is a more significant move than any of these other moves, according to this particular indicator here. And obviously the direction of that move is to the downside. If you look at today's intraday chart, you'll notice that we did get a new 4-week low point. So the Arun indicator, which we look at to kind of, here we go. This is the chart we look at to see how bearish we are. We broke out, the negative broke out a while ago. The positive is just now getting close to the bottom, and that's about the time you start looking for a low point to be developed, when that green line gets down to 0. So you're getting closer, but again, I wouldn't expect it to be like the low point. It may be a very short-term low point, but we're obviously in bearish mode on a lot of these indicators. You can also see too on the whole, when you smooth out this move, you notice that very bearish there. The red line, the hole has just turned over. The 20-day hole has just turned over. We're just now getting below the 200-day hole on IWM. The Qs, we're well below the 200-day hole, working our way below that. The parabolic star is way up above us. And you can see we've been red on the 20-day for a while, and then SPY. Remember, you have to get above the 20-day for it to turn green. So we're not close to turning above the 20-day. Give it another day or two, and we can catch up pretty quick. But it's got to get up above it first before it turns green, and it might take a day or two. But and if you look here at the Hakunashi candles, that we had a bearish. That's still a bearish close in the Hakunashi candle today. Now it's highly doubtful we'll get a bearish close tomorrow on the Hakunashi candle, but we'll see if we end up still with a bearish candle without the long upper shadow. So that's what we're seeing. So again, I think I said last night in last night's video, we're going to get up days, and to not get worked up about whether or not these up days are now like, oh, this is the low point. I mean, we gapped down, we filled in the gap. That was totally what we expected to do. It was a lower high and a lower low, but we did not close below the low. So it's not that bearish. You can see how much further we'll probably come back up to. So probably around 437 by the time this little short-term rally, by the time this near-term rally is over with. And how far up the near-term line ultimately gets on that remains to be seen, right? If it gets up to 60 and that's it, and drops, then again, that will be just as bearish of a near-term peak as that one was. We would expect a new near-term low to come out of it as well. Let's take a look at the VIX. The VIX jumped up at the beginning of the day. Oh, first of all, let's look at the volume here. Whoops, wrong chart. Let's look at the volume first. So the volume here was 119 million. The range, because we filled in the gap, the range is almost 10 points. So just a little bit below the average, or above the average. So 9 points is right up there. That's above the average, but not extreme. Not like, oh, this is so big, kind of like these 2 days, that this has to be a low point. So that's why, there's a pretty decent chance we don't rally that much. Maybe to 437, but we might not get the same kind of rally because we're not getting that big of a move. Today's range wasn't so crazy. And the volume, 119 million, is actually not so crazy either. Above the chart, but above the average, but still on the chart. So those are, when you get numbers that are above the average but still on the chart, that when you're not off the chart. See, these were that range was 17 points, well off the chart. This one was 19 points, the range, well off the chart. And the volumes on those days, when you look at the volume here, again on both those 24, those were both the 24th of the month, which is coincidental. But when you look at the volume on those days, so there's the 24th. January 24th, you can see the volume on that day was extreme, right? 252 million shares trading hands. This is the February the 24th. You can see the volume was extreme, 213 million. You put those numbers in the context here. 213 million, well off the charts. 252 million for this day, well off the chart. Today's volume was 119, not so extreme. So you can see that this is. I wouldn't expect the nice sharp snapback that we saw in any of these days. I would expect more of. We'll probably continue a lot of this selling to the downside here because we didn't really blow out. And you notice that the volatility index, it jumped up, but ended up finishing still below 95. So it's actually still in neutral zone. So it's hardly at an extreme either. So there's still plenty of room for it to get up above that 100% mark. Because remember, when you're in a correction mode, full-on correction mode, you spend a lot of time above 100%. So there's COVID. You see how long we spent above 100% on COVID. We spent, from February the 24th when it got up there and stayed all the way through until April the 24th. So 2 months it stayed above 100%. That was during the COVID correction. During the 2018 correction, we stayed pretty much above 95% from October all the way through to about January of that year. So a few months of high volatility levels there. 15 and 16, there's 15 and 16 right there. You can see some extended period of times above 95% there. And 2011, if I have it, yep, right there. There's 2011. You see how much we spent above 100% and then how much longer we spent above 95. So we haven't gotten above 95 yet. We've had some time here so far, but we're not back above 95% yet. So again, not a blowout move to the downside in the least bit. So I think there's still plenty of bearishness. We might get maybe another day of bullishness tomorrow, but it might be kind of an opposite day tomorrow where we rally up early and then come back down late. I think by the end of the week here, we'll probably be more bearish. So a lot of that will be susceptible to these earnings announcements from the big tech over the course of the week. The technical picture is set up for us to be bearish by the end of the week, to continue the move higher in volatility to the upside and to continue these moves below these moving averages. Probably not such big moves, but probably end up more towards the lows here that we've tested before by the time we're done. And slow enough to allow these moving averages to catch down to them. So what do you think? Do you agree with that? Do you disagree? Let me know in the comments section. And as always, reply to the Market Outlook tweet that I got pinned to the top of my profile with any charts you're looking at. Share. Let's share. Let's get in the habit here of sharing what charts or images you're seeing that kind of is fueling your market posture, and whether you're a lot more bullish than I am or a lot more bearish than I am. Reply to that tweet with what you're looking at. And let's keep this conversation going here. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Do you like the video today? You want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. Also, while you're down there, comment. What did you get out of the video today? What stood out to you, or what questions or comments do you have? Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, if you come down on the right, you can see some of these other things. Click on this icon. That takes you to our Market Outlook live page. This is where I do on Monday, Wednesday, and Fridays, I do a Market Outlook live at 3:30 Eastern time. About 10-15 minutes, I check out all the old trades that we've done. I look at today's trade idea here, so you can be able to see all the archives down here as well. If you come down here and click on View More, you can see our calendar of upcoming events, as well as 4 years worth of recordings of all of our classes. You can check that out there. Come down here, click on this heart. It opens up this tab. Hit that like button. Also click that thumbs up icon. Same thing for Facebook. Click that like button. Again, the more you do that, it helps get our content out to more of our followers. The more likes it has, the more likes and shares and retweets. So that's why we always ask. It benefits you because Twitter and Facebook promote content in your timelines from the accounts you engage with the most. So we try to make it really easy for you to engage with us right now while you're watching right here on this post. All right, now let's take a look at what's driving the price action today. And you can see bonds were up early and they stayed up all day. But, while they were up, stocks were down, commodities were down, but they really came up by the end of the day. Big time move. Commodities were down 3.25% at the lows, and then they only ended up down 0.75%. And you can see gold was down pretty much all day as the dollar is just really continuing to move higher. Remember, we talked about the strength in the dollar, and a lot of that previously had been the strength in the euro and the yen. Well, now you can see the strength in the dollars coming from, these previously had been coming from the weakness in these commodity currencies. But look at what happened today. The yen dropped sharply again. The euro dropped sharply again. That's 70% of the dollar index, how the dollar compares against, I remember the trade-weighted index, the biggest currency by far is the Canadian dollar and the Mexican peso as well. These two are two of the bigger weightings in the trade-weighted index. But in the futures contract, the dollar index, it's made up of the euro and the yen, and that's why your dollar strength is so strong right now, even though there's kind of this risk. It was a risk appetite move. You wouldn't think the dollar would rally with stocks, but it's rallying because these two are dropping so sharply, and how long these currencies are just so parabolic, right? The U.S. yen, if you take a look at the U.S. yen here, especially on the directional movement index, has gone so parabolic here. Look at that ADX almost hitting 70. I don't know if it's ever hit 70 before. If I were to go out, maximum available. If I look back, you can see it got up to 56 there on that run, and then you can see it got up over here a few times. Let me let it finish loading all these dates. And here, let me get this too so I can be able to see. There we go. So it got up to a few times over here in the 60s as some pretty strong moves to the upside. Here's some more up towards 60 as well. Some very strong parabolic moves. It did get here up towards 70 on the downside when the dollar was dropping in 1987, but we've never seen it go all the way up to 70 on this kind of a move. So this is a very, very extreme move here for the dollar against the yen. Very, very bearish. In fact, looking at it here on the monthly scale, and you can see the monthly candle, we're only a few days left in the monthly, and the negative indicator is already below 10. The positive is up above 40 on the monthly chart, mind you. So these are two very strong months going parabolic here. But you can see like the yen has been like in the 80s and in 90s, it's been higher. But here in the more recent, since the euro became a thing in 2000, about 135 is about the limit. I mean, we are in the upper percentiles of how strong the dollar has gotten against the yen, relatively speaking. And you can see it's been so bearish. That's why the yen is such a safe haven currency. It's been so down, such a value. But that's quite the move, right? And then you look at the euro US dollar, and you can see it's at one of its lower values that it's had for the for the most part of this last couple of decades here, flirting with the lows that you saw back in 15 and 16. Very, very significant move, and its monthly DMI, the positive, is getting down there. In fact, when you look at the weekly version of the DMI, the positive is down below 10, and the negative is up here, up above 25. Your ADX is relatively high as you're flirting with some really strong bearishness there. So very parabolic moves, to say the least, in the yen and the euro, which is making the dollar, really have some significant strength, where it's not nearly as strong as against some other currencies, right? The Australian dollar, you can see like it's pretty high. Like the Australian dollar is lost a lot of value the last few days against the dollar, but going back to, it's at the same value it was, say, back on March 15th. If you look at the US dollar versus the yen, this is where it was at on March 15th, right here. The dollar is way higher. It's the same value against the Australian dollar now. It's way higher than it is against the yen. And if you look at the dollar versus the euro compared to where it was on March 15th, which is right here in this area right here, you can see the dollar is stronger. The euro is down versus the dollar from that period too. So it's really weakness in these areas that's driving a lot of that dollar strength. And the other thing too, it's driving that is bonds. Bonds really rallied today. I got the question over the weekend is how can bonds go up when the Fed's expected to raise rates 11 times this year, 11 25 basis point hikes? Well, because of issues like this, right? The bond market has priced that in, and you've gone so parabolic. You're pricing in this expectation is now that it's priced in what it's expected, and we're getting what the bond market expects. You'll start to see in profit taking, right? Especially when there's very, very little volume above us. You move down so far so fast, there's no volume above us for resistance. It's very easy to move up and fill in these gaps between these moving averages, especially now with the MACD above its moving average. You watch to see if we're going to get above that 17-day, because that will be a new bullish divergence forming at that point. Right. So we've also been watching Bitcoin as a reflection of risk appetite. You can see there's, things haven't changed there. You can see a very strong support level forming here. Really, you break this 50% retracement, and about 35,000 essentially, and that's going to be moving strongly to the downside. Let's look at the sector moves today on the comparison basis. And we'll just look at today alone. So let's go out to April the 25th. And let's do what we see here. And you can see snapback and those oversold. Remember, they were the biggest losers over the last couple of days. So, these big drops that we've seen, they were some of the bigger moves to the downside Thursday and Friday. And then now they're bouncing up. And you can see energy material still struggling with the strength in the dollar. Staples. Real estate, utilities, all still hanging in there too. Some outperforming gains. But it's a pretty decent move today alone in these areas. Whoops, other direction. Some pretty decent moves in these areas, and you expect that they will lead any bounce backs to the upside. But again, expect that to be short-lived unless we really break out to the upside. And today, as we talked about, was clearly not that day. It was just more of a it's more of a, since the impulse moves are now to the downside, today was more of an exhale, just to the upside now. We're accustomed to because markets are bullish way more often than they're bearish. We're accustomed, and since most people haven't experienced bearish markets, because we have so many new traders and things coming out over the last couple of years. And the last real correction we've had was fourth quarter 2018. Seems like an eternity ago, but considering all, with COVID and Robinhood and all the interest over the last couple of years, a lot of people haven't experienced a big correction yet. And so we are accustomed to our exhales being to the downside. Well, now, because the impulse moves are to the downside, the exhales are to the upside, and that's kind of what you're seeing with that rally there today. All right, so let's take a look at stock that is in an area that's actually pretty decently bullish today, and it kind of a little bit of an engulfing pattern forming here is Lennar. It's in the home building area. Man, it's been so bearish. It's been way more bearish than most other areas in the market right now. Good day today. Obviously stopped the bleed. The near term line did not get to extremes this go around like it did over here on these clusters. So it's been progressively getting these higher lows on the near-term line. You're getting bearish peaks, but we're also getting some bullish low points. So there's opportunity here that we might be kind of basing, especially considering most of the bearishness has occurred already in this space. you can see the transition candles forming after the big bearish candles. You're getting transition candles with smaller ranges forming, and PPO, as low as it is, appears to be kind of trying to figure it out, right? Figure out a low point in this space. Again, not that you're strongly bullish in this spot, but considering that it seems like it's experienced most of its bearishness, whereas other areas haven't. Obviously, you're in this 50-day. The 50 days way below the 200-day. We are above the 17-day for the first time in a while, and with the MACD above its moving average, stochastics rising. So that's a good bullish breakout, above the 8 and 17-day moving averages today at the same time. Looking at the directional movement index, you can see that we are not bearish anymore. You're not strongly bullish either, but you're kind of done being bearish. When you look at the RSI and the CCI here, you can see again, not strongly bullish levels, but not in bearish levels anymore. Let's go to let's see here. Let's go to the the Bollinger Band. Sorry. Let's go into the Bollinger Bands, and you can see that we are in the upper, like in the midpoint of the range, right? So we're at the 50th percentile there. Again, not bullish, but not bearish anymore on that standpoint. And then from a Ichimoku cloud, where we did have a trending, a strong bearish trend going, we're above the green line. It appears that we might be slowing down the strength of this bearish trend. And I think you're going to kind of work into this area right here on any kind of bullishness that we may get. So I'm not strongly bullish on this stock. There's obviously some significant resistance above us. But I see a low forming and some opportunity to move in the short term in a small space. So what I decided to do on that trade then was to say, okay, well, let's take a look at doing a doing a bull put spread. So selling the 76, buying the 74 strike, going for the mid-30s delta on that. At least it was at mid-30s when I was looking at it. Mid-30s delta, so position sizing normal, going for the normal risk. You can see that break even there is right below all these lows and pretty much right below today's low. So we'd have to essentially reverse this move and break back down there for us to get out of the trade, which at that point, that would be a significant break. And we'd want to be out of the trade at that point. It'd be last week's low point. It'd be today's low point. There's the outside day and the engulfing pattern. We'd be back below the 4-week point of control. Like that would be significant. And so we want to be there. But if we stay in the upper half of the 4-week range, which it looks like we're headed towards, even if it doesn't go too far, great. Doesn't matter. As long as it stays up here, that's all that matters, right? As long as it stays up in this area, time decay will eventually, as you can see here, time decay will eventually work in our favor. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Also, you can subscribe to our website at marketscholars.com. Like us on Facebook and Twitter as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.